Let's bring in Simon Maughan, a banking analyst at MF Global here in the UK. Simon, thanks very much for joining us this morning. Did Deutsche Bank sufficiently ease concerns today about possible fallout from the Goldman Sachs suit?
Well, no, they didn't, and that's where the focus has been. Maybe last year we'd have been going through their level 3 asset disclosure with a fine-tooth comb or details of their write-downs. Now people are analysing word by word the change in their legal disclosure. They came onto the conference call to say that they have not received a Wells notice, that they are unconcerned that they are facing issues similar to those which Goldman is facing, but nonetheless there have been changes in their disclosure and there are some risks out there.
Indeed. Now, investment banking once again drove earnings at Deutsche Bank. Was that enough?
Well, I mean, it should be. Deutsche has reported an average return on equity of 15% in the last 5 quarters and has been profitable in all of them, and each one reporting at least double-digit return on equity after tax, and still trades below book value.
Yeah.
I mean, the stock is probably 30% too cheap on any standard valuation metrics. That just shows you the level of discount, the level of uncertainty the market is applying to changes, potential regulatory changes in investment banking. People just don't know.
Yeah. Now, asset wealth management, that didn't do particularly well, did it?
No, it didn't, and having reported a couple of quarters of profit at the back end of last year, to slip back into a loss, albeit much lower loss than 12 months ago, it is disappointment. But we must remember they are absorbing the cost of Sal Oppenheim, which was not a particularly profitable business, and only as that integration gets underway, they reduce the risk and the risk-weighted assets in it. Only then will we see a boost in profits. So we can put down the weak quarter largely to the Sal Oppenheim acquisition.
No, we also had a trading update from Lloyds. The CEO says that Lloyds will return to profit in the first quarter. You have both Lloyds and RBS at a sell at the moment. Why is that?
Well, at the moment, Lloyds is funding absolutely fine, and it's doing what it said it would do. Impairments are coming down, and the margin is improving. I mean, actually, both of those banks are on massive life support from the Bank of England. In particular, Lloyds. I mean, it would be virtually impossible for things not to be improving. And Lloyds has detailed on the conference call this morning how they are running slightly ahead of their funding schedule for 2010. That doesn't concern us. What concerns us is 2011, 2012, when residential mortgage-backed securities, thin spread, lower quality, formerly HBOS mortgages, come out of the Bank of England life support machine and have to be refinanced by the private markets. We don't think Lloyds will be able to meet its guidance of an only 10 basis point reduction in margin when that happens. We think there'll be disappointments to earnings.
Simon Maughan, thank you very much indeed.